Tuesday night, 11:40 p.m. You're not supposed to still be awake. You open the investment app one more time before bed. Out of habit more than curiosity. The way you check it almost every night now, and there's a number on the screen. That makes you sit up in bed and actually read it twice. Your portfolio gained $612 today. Not from anything you did, not a deposit, not a trade, not a decision. The market simply moved, and while you were at work answering emails, your money made more than your paycheck did for that same 8 hours. You do the math you've never done before sitting there in the dark. You contribute $500 a month. Today, doing absolutely nothing, your portfolio made more than that in a single afternoon. Here's the question that keeps you up another 40 minutes. If the money is already making more than you are, why are you still stressing over finding an extra $50 to contribute this month? Rewind 4 years, because the beginning matters more than people think. You're 27, opening a brokerage account for the first time, embarrassed that you're starting this late, watching a friend's Instagram story about a vacation. You can't afford while you set up an automatic $500 monthly transfer you're already dreading. The number in the account reads $500 after the first deposit. It feels insulting, honestly. Next to the vacation photos, next to the new car in your other friend's driveway. You do it anyway. Here's the part almost nobody explains clearly when they talk about investing, and it's the entire concept this video exists to walk you through. There's a specific, calculable point where the money your portfolio earns on its own, purely from growth, starts to matter more than the money you personally add to it. Financial planners sometimes call it the crossover point. Nobody puts it on a t-shirt because it doesn't sound exciting, but understanding exactly where that line sits changes how you think about every single dollar you save for the rest of your life. Let's do the actual math. Because vague concepts don't change behavior, specific numbers do. At a historical long-term average, stock market return of around 7%. Annually after inflation, here's the crossover point for someone contributing. $500 a month or $6,000 a year. Your portfolio needs to reach roughly $700. At that size, a 7% annual return generates about $6,000 on its own, the same amount you're contributing through an entire year of paycheck deductions, coffee skipped, and dinners not gone to. Below $700, your own contributions are doing the heavy lifting. Above it, the money you already have starts doing more work than the money you're about to add. If you're contributing $1,000 a month instead, $12,000 a year, the crossover point simply doubles, landing around $171,400. The relationship is linear and almost embarrassingly simple once you see it laid out. Divide your annual contribution by your expected return rate. And that's the number where the balance of power in your financial life quietly shifts from you to your money. It's worth pausing on how strange this actually is once you sit with it. For your entire working life up to this point, effort and outcome have moved together in a way that felt intuitive. Work more hours, earn more money. Save more aggressively. Watch the balance climb faster. The crossover point is the first moment where that relationship quietly inverts, where the asset itself starts contributing more than the human feeding it. And most people never actually calculate the exact number where that shift happens for their own situation. They just vaguely sense one day that the account seems to move a lot on its own, without ever pinning down when that started, or what it actually means for the decisions they're making right now. You hit $700 in your 4th year, faster than you expected, partly because the market had a good stretch, partly because you never once skipped a month, even during the year your car needed $20,200 in repairs, and you genuinely considered pausing the transfer. You didn't pause it. That decision, more than any single stock pick or lucky timing, is what got you here 4 years early instead of 6 or 7. Here's the twist that catches almost everyone the moment they actually cross that line, and it's the part the exciting version of this story conveniently skips. Crossing $700 does not mean you should stop contributing. This is where a huge number of people, the moment they do this exact math and feel that rush of, the money works harder than I do now, make the expensive mistake of easing off, telling themselves the portfolio's got it from here. Here's why that instinct, as satisfying as it feels, is actually dangerous, and it's the twist that determines whether crossing this line makes you wealthy or quietly stalls you out for the next decade. Average returns are an average. They are not a guarantee, and they are absolutely not a schedule. The 7% figure is a long-term average smoothed across decades of genuinely brutal years, mixed with genuinely spectacular ones. In any single year, your actual return could be negative 15% just as easily as it could be positive 22%. If you cross your crossover point and then immediately stop contributing right as a bad year hits, you're not just missing out on a good year's growth. You're removing the one lever you actually control, your own contributions, at exactly the moment the market's not cooperating. This is called sequence of returns risk in the technical literature, and it's one of the quietest, least discussed dangers in the entire personal finance conversation. The order in which good years and bad years arrive matters enormously, especially in the years right around a major milestone like your crossover point. Someone who crosses 700 and then gets hit with 2 rough years in a row, while having stopped contributing, ends up in a meaningfully worse position 5 years later than someone who crossed the same line and kept the $500 a month flowing regardless of what the market did that particular year. Think about 2 versions of you, splitting off at the exact moment you hit 700. Version 1, the one who feels vindicated, quietly reduces the monthly transfer to $200, telling yourself the big number is doing the real work now and you deserve a little breathing room. Version 2 keeps the full $500 flowing exactly as before, treating the milestone as proof the system works rather than a reason to loosen it. Run both versions through a rough 2-year stretch with 1 down year and 1 flat year. And version 2 doesn't just end up with a bigger balance. The gap between them is bigger than most people expect, because the shares bought during the down year at the discounted price do disproportionate work once the recovery arrives. Version 1's smaller contributions bought fewer of those discounted shares, and that gap doesn't close on its own. It has to be earned back. You learn this the hard way or almost do. 6 months after your app shows that $612 day, the market drops hard. One of those stretches where every headline uses the word correction, and every group chat gets a little quieter. Your portfolio, sitting around $91,000 at that point, drops to $79,000 in about 5 weeks. You watch the crossover point math you were so proud of quietly reverse itself. Your annual return capability dropping back below your annual contribution again, at least on paper, at least for now. Here's the moment that actually matters, more than the $612 night ever did. You don't stop the transfer. You don't even consider it this time. Because you understand something now that you didn't understand 6 months ago. The $500 you're contributing during a down market isn't just habit anymore. It's buying more shares at a lower price than you were paying before, quietly setting up the next recovery to work even harder in your favor than it otherwise would have. The crossover point isn't a finish line, where saving stops mattering. It's a shifting threshold that moves with the market. And the people who treat it as a permanent finish line are the ones who get caught flat-footed the first time. The market reminds everyone that averages are made of extremes, not steady, boring middles. The market recovers over the following 10 months, the way it almost always eventually does, and your portfolio crosses $700 again. For real this time, sturdier this time, because you kept feeding it through the exact stretch, when feeding it felt the most pointless. So here's what the concept actually means once you strip away the exciting headline version of it, the version that makes it sound like a permanent invitation to relax. First, calculate your own real number, not the example number. Take your annual contribution. Divide it by a conservative expected return, somewhere between 5 and 7%, depending on your actual portfolio composition, and that's your personal crossover point. It's not a universal constant. It's specific to how much you're actually putting in every month, and it moves every time your contribution amount changes, which means it's worth recalculating every year, or 2, rather than treating it as a number you figure out once and file away forever. Second, treat crossing that line as a milestone worth genuinely celebrating, not a signal to ease off. The psychological shift matters enormously. Watching your money's own earning power catch up to, and then exceed your monthly effort is one of the most motivating moments in anyone's financial life, and it deserves to be acknowledged, just not acted on by reducing contributions. Mark the date. Tell someone. Let yourself feel the win. Just don't let the feeling talk you into touching the transfer amount. Third, understand that the number moves. A bad market year can knock you below your crossover point again, even after you've crossed it once. And that's not a failure. It's just the nature of investing in something that doesn't move in a straight line. The people who build real wealth over decades are the ones who've made peace with recrossing that line more than once on the way up, sometimes 3 or 4 times across a full investing lifetime, each recrossing a little less dramatic than the last as the base gets larger and more resilient. Fourth, keep contributing through the downturns specifically, not despite them. This is the single hardest piece of behavioral discipline in all of personal finance, and it's exactly backwards from most people's instinct. Buying more shares while prices are down is precisely what turns a temporary market dip into an accelerant for your next stretch of growth. But almost everyone's gut tells them to do the opposite at the exact moment it matters most. The contributions that feel the most pointless in the moment are, almost without exception, the ones doing the most disproportionate work in hindsight. Fifth, recognize that your crossover point isn't really about hitting a number and stopping. It's about hitting a number and changing what your contributions are actually for. Below the line, your contributions are the primary engine. Above the line, your contributions become insurance, a hedge against the exact kind of sequence of returns. Risk that catches people who quit too early, keeping the machine fed and resilient instead of leaving it to run entirely unsupervised through whatever the market decides to do next. Sixth, resist the very specific temptation to lifestyle inflate the moment you cross the line, which is the sibling mistake to reducing contributions and just as common. Crossing $700 doesn't mean the extra $500 a month suddenly belongs to a nicer car payment instead of the brokerage account, even though it can feel psychologically like the account has graduated and no longer needs your help. The account graduating from needing you as its primary engine is not the same thing as the account no longer benefiting from you at all, and conflating those two ideas is exactly how people stall out at $100,000 for years instead of compounding through to their next real milestone. It's worth naming, honestly, too, because it's rarely a single dramatic decision that causes the stall. It's 100 small ones. A nicer dinner here, a skip transfer there, each individually harmless, each collectively the reason. So many people cross this exact line and then plateau for years without ever quite noticing why. You're 31 now, 3 years past that first $612 night, and the portfolio sits comfortably above $140,000, climbing toward the crossover point for the higher contribution rate. You eventually worked up to once a raise came through. You still make the $500 transfer, now closer to $700 every single month, including the months the market makes it feel almost silly to bother. Especially those months, actually, because you understand now that those are the months doing the most quiet work of all. The $612 night wasn't the moment your savings stopped mattering. It was the moment your savings started mattering in a completely different way. Less like the engine and more like the fuel that keeps the engine from stalling out exactly when it can least afford to. There's a version of this story a decade further out worth picturing too, because it's the one that actually explains why any of this matters beyond a single good night checking an app. By your late 30s, the crossover point you calculated at 27 looks almost quaint, a distant early milestone rather than a destination, because the portfolio has crossed and recrossed that shifting line half a dozen times on the way to something much larger. The habit that got you there was never the specific dollar amount. It was the refusal year after year, downturn after downturn, to let a single good night convince you the work was finished. So here's the real question underneath all of this. Once you calculate your own crossover point and actually watch your portfolio's daily swings start outpacing your monthly contribution, will you treat it as permission to coast, the way almost everyone's gut tells them to? Or would you understand it as the exact moment your contributions quietly became more important than ever, just for a completely different reason than the one that got you there? Almost everyone chases the finish line feeling. The people who actually compound wealth for decades are the ones who realize there wasn't a finish line waiting for them at all.